Okay. Yeah, I'm not sure what just happened, but okay, I'm just gonna continue. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Every distribution of the material is strictly prohibited. Hey, I'm Melanie and I'll be your speaker for today. I'm an investment analyst at Rocket, who are finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. First, we'll define what seasonal patterns are, and then we'll look at how these patterns are formed, followed by practical strategies for trading seasonal patterns. And if we have time at the end, we'll look at some live charts. So if you have any requests, feel free to pop them into the chat during that time. Okay, so what exactly are seasonal patterns in financial markets? So in simple terms, they are regular, predictable price movements, or basically market trends that occur around the same time each year. By definition, um, they represent predictable trends or fluctuations in asset prices that occur at certain times throughout the year. So an example of this can be in the stock market where there is something called the January effect, where stocks tend to rally in the first month of the year. So in commodities like gold, we often see price increases during specific periods, such as the wedding season in India, which drives up demand for gold jewelry. Similarly, agricultural commodities like wheat or corn follow harvest cycles, influencing their prices. Can everyone still hear me? I'm not sure why my Zoom is kind of uh, acting out a bit. Okay, seems like everything is okay. Yeah. So this obviously basically lies in the fact that market movements often correlate with seasonal activities in all calendar periods. So the understanding or the study behind these formations can provide a useful guide for timing your investments and trading decisions. So apart from the January effect, there's also um the Christmas rally where the US stocks or US stock markets often strengthen toward the end of December with Christmas and New Year season. And then there's also a sell in May and go away, which is another popular strategy that suggests offloading shares in May and re-entering the market in October, basically to avoid the summer stagnation. Okay, so how is it determined? It's basically determined by either the average profit or loss for a certain period in terms of financial instrument analyzed. Of course, in these examples that I'm giving, we're talking about stocks, or by merely evaluating the net positive or negative performance during that period. So, for example, um, the pound dollar, if we're talking about Forex, experienced declines in 8 out of the last 10 Februaries. But we'll talk a bit more about each individual financial instrument in a bit. So why do seasonal patterns occur? Firstly, economic cycles play a pretty significant role. So, for example, consumer spending arises during the holiday season, like I mentioned previously. These obviously lead to higher retail sales and sometimes affect stock prices as well. Secondly is market sentiment. So this is a crucial factor, so that's important. It's important to follow or keep up with your fundamental analysis because of this. So for example, investors might sell off losing stocks at the end of the year for tax purposes, which often leads to a dip in December, followed by the January recovery, hence the January effect. And lastly, geopolitical events and global factors like weather, holidays, or even war. So these can obviously also impact your markets. So basically think about how travel seasons can increase the demand for oil, or how geopolitical tensions can drive up gold prices due to its status as a safe haven asset. Okay, so next let's look at how exactly they're formed. So they're often identified through historical data analysis. So analysts will examine years of price data to identify recurring trends. For instance, if we notice that a commodity like oil typically sees price increases during the summer, this could point to a seasonal pattern tied to higher demand for fuel during the driving season. Fundamental drivers such as supply-demand dynamics, economic reports, and geopolitical events also shape these patterns. In the case of gold, central bank buying or rising inflation fears during certain periods can lead to seasonal price rises. Technical drivers include recurring chart patterns, momentum indicators, or moving averages that coincide with these seasonal trends. So for traders, the ability to combine fundamental and technical analysis is key to understanding and capitalizing on seasonal patterns. So I'll go through some of the strategies um, to combine your fundamental and technical analysis in a bit. Okay, let's start off with gold. We're going to look at diving deeper into trading seasonal patterns. So particularly in the case of the gold market, it's driven largely by demand cycles. So, for example, we will often see gold prices rise during the wedding season in India, as I mentioned earlier, because of jewelry. And this is typically between September and November. There's also increased demand in December and January when investors look for safe haven assets to hedge against market volatility or inflationary concerns. Um, this basically happens throughout the year when there are announcements on your CPI, or inflationary concerns in general. And lastly, a popular trading strategy is to buy gold during the summer months when demand is relatively lower and prices tend to dip. Conversely, traders might sell or hedge their positions as demand peaks in late fall and winter. Using seasonality charts, we can see how these trends repeat over time, providing a framework for strategic decision making. Okay, next, let's take a look at oil. So, in the case of oil, the seasonal patterns are largely influenced by global supply and demand cycles. So, in the summer months, especially in the US, the demand for oil typically rises due to the driving season. So more people will be traveling, going on road trips, and this increase in demand can drive prices higher. Similarly, during winter months, there's higher demand for heating oil, especially in colder climates, which can also push oil prices up. Key factors influencing oil prices include OPEC meetings, production cuts, and geopolitical tensions in oil producing regions. For instance, a cut in oil production ahead of the high demand winter season can exacerbate the price rise. So for traders, one strategy is to go long on oil ahead of these peak demand seasons and sell before production ramps up in the spring or fall, demanding on supply dynamics. Okay, next let's look at the FX market. So in this case, seasonal patterns are largely influenced by macroeconomic factors and interest rate cycles. So earlier I mentioned the pound dollar. So in this example, the euro dollar pair often shows strength during the summer due to higher European tourism revenues. So another example would be the Australian dollar, which tends to rise during its summer months when export demand for commodities like iron ore is strong. So a typical strategy in the FX market is to trade based on interest rate cycles. So traders can anticipate when central banks are likely to adjust rates and position themselves accordingly. So for instance, if we know that the seasonal economic activity in Australia will lead to a central bank rate hike, we might buy Aussie dollar in anticipation of this move. Okay, next let's look at some of the risks involved with trading seasonal patterns. Firstly is volatility. So volatility can disrupt these patterns. The example here is that unexpected geopolitical events, so like your wars or natural disasters, can break established trends. Even if a seasonal trend exists, real world events can cause markets to behave unpredictably. Secondly, over reliance on past data can be dangerous. So just because something has happened in the past doesn't mean that it will definitely happen again. So it's essential to analyze the current market environment to see if those conditions still hold. And lastly, diversification. So you don't want to rely solely on seasonal patterns in your trading strategy. Instead, you want to use them as part of a broader risk management strategy that includes other tools and insights. Okay, so let's now talk a bit about practical tips for trading seasonal patterns. So firstly is to combine technical and fundamental analysis, and I'll show you in a bit how we can do this to confirm that a seasonal pattern is developing. You can use charts to identify price action and technical indicators that match historical seasonal trends. And as for your fundamental analysis, you can of course also use different economic calendars to keep up to date with um, the economic data releases or events that are happening around the world, because those have a very big impact on, as you mentioned, Forex currencies, since they are influenced largely by macroeconomic events. And also gold is considered a safe haven asset and is largely influenced by our DXY as well. So it's important to keep track of the central bank announcements. And obviously, it's easier to keep track of those if we use an economic calendar. And I'll give you some examples in a little bit. And secondly, is to always backtest your strategy using historical data to see if the seasonal pattern holds up over time. Many platforms offer tools to help traders backtest their seasonal trading strategies. Okay, any questions so far? Oh, um, has my audio been okay? I just received a chat saying that my audio is bad. Is everything okay? Can you guys see me? I'm not too sure why my computer is acting up today. So just let me know if like anything is wonky. Yeah, okay. I think my audio is fine. The video stopped. Okay, can you guys see me? Let me just refresh my video. Okay, can everyone see me now and hear me? Okay, great. Thank you guys. So sorry about that. I don't know why this is happening, but okay. Um yes, we were talking about the last point. So the last tip for trading seasonal patterns is making use of leverage tools. So, using tools like seasonality charts and market reports that highlight upcoming trends, or even just using an economic calendar to keep up to date with the upcoming data releases. These tools can provide you with a roadmap for when and how to trade based on seasonal patterns. Okay, so I talked a bit about backtesting in this second point, so I just want to dive a little bit into that. Okay, so what exactly is backtesting? So backtesting in trading basically is simulating the process of trading while using a set of rules over previous price data to see how much money would have been lost or made if a trader had followed the same strategy. So that's why this technique is really helpful when it comes to using when it comes to trading seasonal patterns. Okay, so backtesting essentially is a retroactive test where a trader enters a set of rules, so like a currency pair, a time frame, or your choice of technical indicators. Then the automated backtesting trading system can analyze the tick data and show what would have happened if you had taken the chosen strategy. Okay, that's just the definition. Yeah. So what to watch out for? Obviously, you want to take note of your net profit or loss, volatility measures, um, averages. This can be like your moving averages that can help you when you're looking out for that as well. Ratios and annualized return. Okay, what is tick by tick back testing? So this basically involves in-depth data analysis, volume weighted into price, creation of elaborate models, preventing unexpected surprises, and simulation of trade execution. This is kind of what we covered already. Okay, so here is an example of a backtest report. This is from MT4. I'm pretty sure you can do the same thing on MT5 as well. So yeah, you can try that out. So there are four key areas that you want to look out for when you produce your backtest report in MT4 or any program that you're using. Firstly would be your total net profit, your maximum drawdown, total trades, and the profit trades, so the percentage of the total trades that you've made. Okay? Okay, overall key points. I'm just going to summarize each point of this slide. So it's basically highlighting why exactly we want to take note of these points from this chart. I mean this image here. So the total net profit obviously is the overall financial outcome of the trades generated by a trading system if it had been used in the past. So it doesn't guarantee future performance, but it provides an estimate of the potential gains from using the system. Maximal drawdown refers to the largest loss experienced by the trading account in both monetary value and percentage relative to the account balance. So a lower drawdown is generally preferred, but also it depends on your risk tolerance and account size. So for example, if a trader has $10,000 with a risk tolerance of 20%, the maximal drawdown should not exceed $2,000. Total trades obviously represents the overall number of trade positions taken by the trading system. It helps assess whether the strategy is aggressive or moderate by comparing the number of trades to the investing timeline. So for instance, if there are 200 trades in 3 months, it indicates an average of 3 trades per day, making it suitable for intraday trading. And a smaller number of trades may be better suited for mid-term trading. And profit trades indicates number and percentage of profitable trade positions out of the total trades, and it reflects the trading system's win ratio with a higher percentage indicating a more successful system. Okay, here are some common mistakes. Unrealistic backtest results, overmining your data and getting the timing right, or not getting your timing right, as well as incorrect assumptions. Okay, that's it for my slides. I think I have a question in the chat. And then now we'll move on to taking a look at some charts as well. Yeah, so Sylvester has a question. What are the technical indicators that you can use to combine for your seasonal trading patterns? So, like I mentioned, I think in one of the slides we talked about averages. So, one common technical analysis or indicator that you can use is moving averages. So moving averages can be used to identify the general trend and smooth out any price fluctuations. Second indicator you can use would probably be RSI. So that helps you to detect overbought or oversold conditions during seasonal peaks or troughs. Um, Another popular one that I like to use would be MACD, but that's because it's very simple to use. You can spot momentum shifts that might coincide with seasonal price movements, and Bollinger Bands as well, because they assess the volatility and price breakout potential in line with your seasonal trends. Let me think if I'm missing anything else. Yeah, I think that's those are the ones that I can think of off the top of my head. Yeah, those four. So moving averages, RSI, MACD, and Bollinger Bands. They can also help you to, so they can not just validate the seasonal trend, so whether it's an uptrend, a downtrend, it can also kind of help you to pinpoint more accurately any entry or exit points in your trades. Any other questions before we start our live analysis? Is it possible to get the presentation or slides? I'm actually not sure. This session is being recorded. Um, so I think if you email IronFX admin team, the email should be on their website. They'll help you out. But I can't share the slides here. But maybe they'll send you the recording. Okay. Um, we still have some time, so let's go ahead and take a look at some charts. Oh, no. Let's actually start off by looking at an economic calendar first. Okay, so this is forexfactory.com. Okay, there are a lot of economic calendars on the market that you can make use of. This is the one that we normally like to use. Um, yeah, but you can use like investing.com as well if you want. Okay, so the default setting is today's date. So if we take a look at maybe, for example, this week's events, okay, apply settings, and click on this green icon, you can actually look at the different expected impact for of the events. So for example, for the red, it's a high impact event. Orange is medium, yellow is low, and gray is non-economic. So that would include any bank holidays. Currencies, you can filter out any currencies that you're not currently trading. I just prefer to have all of them, to look at all of them. Event types, yeah, you can filter any of them out as well. So you can see if I have all of the filters ticked, there are a lot more events to cover for each week. Okay, so that's why I like to just focus on the medium and high impact events, so the orange and the red icons. Okay, so for this week, Monday, we had the China loan prime rate data, which came out to be lower than forecasted. There was the BRICS summit, UK BOE Gov Bailey speaking, US Richmond Manufacturing Index. We also have Euro and US members speaking. Euro President Lagarde speaking as well, and day two of the BRICS summit. So for tomorrow, Thursday, we have the Bank of Canada monetary policy reports and rate statement. So you can see these are very high impact events as well. Overnight rate is expected to drop to 3.75, down from 4.25. Euro, ECB President Lagarde will be speaking, and US existing home sales data will be released. BOC press conference, US crude oil inventories. You can see it's higher than previous as well, or forecasted to be higher than previous. RBNZ Gov All will be speaking, UK BOE Gov Bailey speaking, and Eurozone wise, we have the French, German, and Eurozone manufacturing and services PMI. We also have the BRICS Summit Day 3, UK flash manufacturing PMI, and US unemployment claims. So US unemployment claims are also high impact event. So you can see the data is expected to be higher than previous. So on Friday, we have US flash manufacturing PMI, UK monetary policy report hearings, US new home sales, UK Gov Bailey speaking, Tokyo core CPI, so this is inflation data as well, and it's expected to drop to 1.7 from the previous 2.0%. German business climate, Canadian core retail sales, and US durable goods orders as well. Okay, so this week's event, so maybe just as an example, if we use US unemployment claims, if the forecasted is correct and the data turns out to be lower or higher rather, higher than 241K than previous, this is obviously a bad sign for the US economy with higher unemployment claims. So what does this mean for DXY? We could see the price of DXY dropping, and in turn we could see the price of gold shooting upwards instead. Okay, let me show you. So we're looking at gold currently. This is the price of gold. If we look at it on our daily time frame, you can see prices are moving in this uptrend. So using this plus sign, you can actually compare two price scales. So I want to compare DXY and gold just to show you guys how they are inversely correlated. Okay. They're not really inversely proportional because you can see just because it rises doesn't mean it drops the same amount for the XY, but you can generally expect the opposite trend to take place for either one. Okay, so that's also another thing to take note of apart from the seasonal trading patterns as well. Okay, let's go ahead and take a look at gold and analyze this together. Okay, so on our weekly time frame, we already saw prices moving upwards in an uptrend. Daily time frame, we see that as well. So now let's see if we have an ascending. Okay, yeah, we have prices moving in an ascending trend line as well. So now that I've established the trend, then I'll now go in with our horizontal levels. Okay, so where price is currently at, I'm gonna label that as um a pivot. Okay, and this will be our support. Okay, because we don't have any higher levels above the pivot that we can use for reference for our first resistance, I'll instead go in and use my Fibonacci projection. Okay, so you can see my 61.8 lines up nicely with my pivot. 78.6, that would be my first resistance. And this would be my second resistance. Okay. Okay, if you're unfamiliar with Fibonacci, just a really quick recap. This is the shape this is the trend line that I used, but this is the shape that we're looking at. So it's kind of like a lightning bolt shape or like a zigzag. Okay, next I'm gonna go in with a extension. Okay, my 161 lines up with my pivot. Okay, for this method, we're looking at a Nike tick. So like that. Okay, so this would be the shape of a Nike tick. If it's inverted, it'll just be like that. Oops, that's really ugly. Like that. You get the idea. Okay. Um, next are maybe let's use an expansion as well. Okay, so for an expansion, we're using the negative levels, namely the minus 27.2 and the minus 61.8. So I'll keep both of those since they both line up. Okay, so what I'm doing here is basically finding areas of confluence. So what that means is there are at least two or more Fibonacci levels aligning in that level, then you can call that a confluence area. So your levels don't really have to line up exactly nicely with the horizontal, so like your support or your resistance levels. They just have to be kind of near it, like this. And yeah, that's good enough. Okay, so I am expecting prices to continue in this uptrend. okay, towards our first and maybe second resistance. So let's take a look at our indicators now to see if they support our analysis. So I'm starting off with Ichimoku and MACD because at one glance you can see exactly what the signals are. So for Ichimoku, price is moving above the cloud, which is a bullish signal. MACD you can see is also a bullish signal here. If we look at Bollinger Bands, can see prices pushing above the upper band, which is a bullish signal as well. Let's look at RSI. Okay, RSI is moving upwards as well, which is a bullish signal. Okay. Okay, so they all support our analysis that prices are going to continue to move upwards towards our first and maybe second resistance. Any questions? Okay, if there are no questions, let's go ahead and analyze the XY. Okay. Okay, so on a weekly time frame, prices are kind of fluctuating. Recently, they look like they're moving upwards. Daily time frame also look pretty bullish. Okay, I'm gonna label my pivot up here where price is approaching because it's in line with a swing high. Okay, for my first resistance, I'll place it here. And my first support, maybe just here. Okay, so a good habit is to try and pull it back as far as you can to see how significant the level is. Because, for example, in this case with our first support, you can see prices tested this level many times before. Okay, so our 78.6 retracement lines up with our first resistance. Even though the 61.8 also lines up with my first support, we can't use it anymore because price has already broken out of that level. Okay, nope. I think that might be all the levels we have, all the Fibonacci that we have. Yeah, okay, let's go ahead and take a look at some indicators then. So here we are expecting prices to continue moving upwards towards our first resistance, hopefully breaking out of our pivot as well. Um, Okay, you can see our Ichimoku cloud, prices are moving above it, giving us a bullish signal. MACD is also giving us a bullish signal here, so they both support our analysis. Bollinger Bands, you can see prices also moving in an uptrend, so that's also giving us a bullish signal. Let's take a look at RSI. Um, RSI you can also see is moving in an uptrend. Okay, we have a question. What time frame do you think is good to identify overbought and oversold while using RSI and parameter settings? Yeah. So for short-term trading, so short-term as in if you're looking at day trading or intraday trading, that would be maybe your 30-minute, 1 hour charts. So for the RSI settings, you would want a more sensitive setting like 7 period RSI so that it can react quickly to short-term price movements. Although I will say on the shorter term trading or the shorter time frames, um, using an RSI may give more false signals due to more noise on the shorter time frames because it is faster paced. Medium term trading, which is what I'm doing now, which uses the 4 hour and daily or even weekly time frames. The default, I think, let's see. Yeah, the default is 14. Um, which is I think most commonly used as well, because it kind of provides a balance between the sensitivity um indicator as well as reliability. So it helps you to identify stronger overbought or oversold signals in your multi-day or multi-week trends. Yep, and then um I guess if you're looking at weekly or monthly charts, so that's more long-term investing, you would then want to use a 21 period RSI so that it smoothens out any market noise and you can get more reliable signals for longer term trends. Okay, I hope that answers your question. Okay, so currently you can also see on our RSI, it is giving us a bit of an overbought signal over here. So we can be aware of that. Um, Yeah, so we're just gonna see if price reverses off the pivot, especially since it's currently um heading towards this swing high level. If it manages to break out, we can go in for a buy towards the first resistance or even towards this swing high here. Um, yeah, but we just want to be careful of this pivot level here first. Okay, any other questions? Okay, if not, thank you guys so much for joining me today. That's all I have for you guys for today. Yeah, I hope you guys found this session helpful. Have a great rest of your week, and I will see you guys again next week. Thanks, everyone. Bye. Thanks, everyone. If you liked me, feel free to connect with me on LinkedIn